Okay, so what exactly is fundamental analysis and how it can instantly supercharge your profitability, your win rate, if you implement it correctly? The first thing I need you to understand is the difference between technical analysis and fundamental analysis. So with technical analysis, you're essentially using past information, things that have happened in the past on the price charts to create a market picture, to create your forecast of what's about to happen. The thing with that is it's not very predictable, right? And that's where fundamental analysis comes in, because ultimately when you're trading fundamentals, or when you're looking at fundamentals or analyzing fundamentals, you're actually trading what's happening now, and with that information you can create future accurate, more predictable forecasts in your analysis, right? So technicals are used for finding entries. Fundamentals are actually used for accurately predicting where the market is going to be going ahead in the future. I can show you this difference. Well, I'll try to show you this difference between technicals and fundamentals as best as I can. So first thing, I'm going to go on the higher time frame and just mark out points of reversals on the chart. So we've got 3 points of reversals. So market was going up due to one fundamental factor. So this was March 2020 to June 21. So the market was going up because of COVID, and for as long as COVID was alive, the market kept going in one direction. That was the fundamental factor that impacted the market. Now, as soon as it comes to summer 2021, that's when lockdown starting easing, that's when economy started opening up again. The markets are not going to continue going up, right? So what they're going to do, they're going to go down, and somewhere in between, the thing that was causing the markets to go down, which for your information is the inflation crisis, which we're still in today. As soon as that inflation crisis has even a potential of slowing down, even a potential of being solved, the market suddenly moved directions. The point I'm trying to make here is that on the higher time frame, it tells you where the market is heading. Yeah, if the market is going in one direction because of one thing, once that one thing gets eliminated and washed away, the market is going to suddenly switch directions. And as soon as the market switches directions, you can jump on it. Instead of you jumping in cells from around here in this down move, you can be jumping in cells from all the way down there and take it all the way down there, right? The job of technical analysis is simply finding entries. So if you're a support and resistance trader, what you would do is just mark out tops and bottoms, significant swing highs and swing lows, and just trade those. Now, it doesn't have to be support or resistance like what I'm doing here. It can literally be any strategy. So it can be EMAs, it can be Bollinger Bands, but the fundamental thing, the ultimate thing still stands. Exactly that the market was going up. I'm just going to quickly go over the 3 steps you need to do fundamental analysis. The first step, the overarching step, is find the context. So what's happening in the world? Is it COVID? Is it the war with Russia and Ukraine? Is it China and Taiwan tensions? The inflation crisis? Is it a potential recession? So what is it that the world is battling? What is it the world or the market is battling with at the moment? Once you know that, you are going to be looking at how central banks of the respective currency are responding to that battle, to that contextual impacting factor. Let's take the Federal Reserve. So the way the central bank is going to respond to this inflation crisis is through supply and demand of the US dollar. So they're going to bring inflation down by reducing the supply of dollars within overall market. After what the central bank is going to do to respond, we can look at market correlations. If there is a reduction in the amount in the supply of dollars within the market, the value of the dollar is going to go up. If the value of the dollar goes up, gold goes down, right? If the value of the dollar goes up, GU goes down. If the value of the dollar goes up, Euro USD goes down. You got literally hundreds of trading opportunities all going in one direction. So predictions become forecasts. So you're essentially analyzing and predicting what the market will do, but you're actually forecasting it with very, very high degree of certainty. I would say 99 to 100% the 1% if you make a mistake in your fundamental analysis, but that is essentially how it would work.